Okay, so I start the recording. So this is the session of the class where we'll be learning how to work with journal entries. So before going to work with the journal entries in QuickBook, I just give you a little bit information about how to work with the journal entries in real life. So let's create some of the items and discuss it. So whenever you are working with the like in the accounting, you have two portions. One side is your asset side, the other side is your liability side. So what is liabilities? The amount you owe, the money you owe. And what are your assets?
Things
These
you
are
own.
that you exactly the money you own. So this is the basic difference. So when it comes to let me type here balance sheet. So now when you're working with asset, there are two types of assets. One is your, you can say a current asset. So what a current asset, which are cash equivalent, like maybe it is your money in your account. It could be money in your hand, like the cash in hand, cash at bank, or maybe you have sold something to the customer and you are expecting money out of it. So those are called receivable. So let me type here cash in hand, cash at bank, or account receivable. So what is account receivable? Let's say you sell something to your customers and you are expecting that you will get your money based on your sales. The other thing is sometimes you paid your expenses in advance. Let's say I'm living in this, I'm not living. Let's say if I have a business and I have paid my rent for 3 months in advance. So it means for this month is only the rent of 1 month, but the 2 months in advance means for the next 2 months money is my asset. If I continue doing business there, then I'll be, you can say, using that rent. But if let's say if I move before finishing the 2 months or 3 months, then I'll be getting back my money. So that is prepaid. You can, sorry. Prepaid rent or prepaid expenses. What is the example of expenses? Let's say if I have paid my utility bills, I am getting $100 bill each month. And I don't want to pay every time, like I don't want to keep track of it. I just go and deposit $1,200 at the start of the year. So now instead of paying $100 every month, I already paid my $1,200 at the start of the year. And now I don't have to worry about it. Since the utility company, let's say the gas company or electricity company or the phone company, they will automatically charge me $100 and they keep on reducing my balance with them. So that amount that I have paid in advance will be my prepaid expenses. So these are my assets. Let's say I use their services for 6 months and I want to finish my contract. What will happen? I'll get the money of 6 months back. So that's why the money that you have paid in advance are your asset, because the money is never gone yet. You have not used that money yet. Your inventories. So let's say you like manufactured the, let's take example of the car dealership. So if you are a car dealer, the cars standing in your you can say showroom are your inventories. You sell them, you get money. If you don't sell them, they are your inventories. So if you sell them, your inventory will be reduced and your cash will be increased. Why? Because when you sell the inventory, you get the cash. Sometimes you don't receive money right away, you receive money after some time. So you sold the inventory, your account receivable will increase. So it depends. One asset is gone against the other asset. So whenever you are doing a transaction, the two items are in action. Either it could be in the same area or it could be in the asset and liabilities in two areas. So another thing, let's say if you are working with the, like these are called, all of these items that I have mentioned here are easily convertible into cash. So that's why they are called current assets. Easily convertible into cash. That's why they are called current assets. Then we have another type of assets, which is called fixed assets. So what are fixed assets? So let's say if I buy something, the intention of buying is not selling. Let's say if I buy a property to start my business there. So when I buy it, it means I don't have intention of selling that property. So that property is my asset. If I buy a car to deliver my goods or inventories to my let's say customers, so then that vehicle that I bought is not my inventory. It is my delivery van or delivery truck. So the property I bought for doing business is my fixed asset. The van, or I type here the vehicles that I bought. I write the word vehicle because it is not necessary that that it is only delivery. Maybe you buy a vehicle to transport, to give the transport service to your staff. Maybe you buy a car for the executives of your company so that they can commute. So all the vehicles that are owned by your company, you have not bought it just for the sake of selling, but for the sake of giving or using in their business, or giving incentive, or giving some comfort to your staff. So these all vehicles are part of your business property or business assets. And because you're not buying it to sell, that's why they are part of your fixed assets. So machineries. So when you are installing the machineries, plant and machineries in your factory, you did not intend to sell those machines. You are using those machineries to manufacture the goods. So these are your fixed assets. Your furnitures and fixtures, the tube lights, the ventilations, the ACs, your computers, your tables, chairs, you did not buy to sell it. You buy those for the sake of like running your business. So these are part of your fixed assets. So what we have learned, if you buy something for sale, those are your inventories. If you buy something to run your business, these are your fixed assets, and inventories are part of your current asset. So let's take example of the car dealer. Cars they are selling as soon as they got the cars from the manufacturer, and now they are selling it. So they cannot put those cars into their fixed assets. Why? Because they bought it with an intention of selling. If I am a property dealer, I am buying and selling property. So if I buy the properties, on the very first day when I buy the property, my intention is selling. So because of my intention, that property will not go into the fixed assets. Why? Because when I bought it, my intention is selling. So it means that is a part of my inventory. I'll be selling this property. So all of these things will it will give us a good idea that whenever we are buying something for the sake of selling, those will be our inventories. But if I buy something to run our business, or for our own company, or to run our business, or to support our staff or something, then those items are part of our fixed assets. Exactly the similar way on the liability side. If we have, let's say, if we have, exactly we have the two type of liabilities. One is the current liability. Current liability has a little bit different definition. Amount of money, amount you have to pay within 12 months. So if you have to pay something within 12 months period, that is your current liabilities. Any question?
No, go ahead.
Okay. So the examples are, again, you see, if you are account receivable is your asset, so accounts payable will be your liability. Account payables, bills payables. So here you have paid the prepaid, but let's say you want to pay your expense, rent, payables, right? Sometimes here you have prepaid, right? So prepaid means you paid something in advance. Sometimes you receive some money in advance. Let's say if I am a construction, I'm working as a contracting company. So a company asked me to build their building, but before starting the business, they give some money to me to start with, like as you can say, as a down payment sort of thing. So I got 25% as a down payment so that I start working on that specific property. So I have got this money, but I have not started working on that property. So this money is called unearned income. I have not earned it yet. Let's say if I don't want to work on this project, I can return this money back and then I'm done. So it means I have not earned that income. So that will be part of my liabilities. If I don't want to work with it, I have to return back this money. So that's why this is unearned income. Then we have the long-term liabilities. Right. So what are the part of long-term liabilities? So if you want to see the long-term liabilities, just see the type of fixed assets. So for the properties, we are paying mortgage. So normally mortgages, we are paying in more than 1 year. Like sometimes we are paying it in like 20 years, 25 years, 30 years. So mortgage loan is our long-term liability. Vehicle. So vehicle finance is our long-term liability. Machinery finance is our, or machinery loan or something like that. These are all our long-term liability. Then we have personal loans for the business, or you can say business loan that we have to pay in more than 1 year. These are called long-term liability. So you can see all the items that you have to go or you have to pay beyond 1 year. Amount you will be paying in more than 1 year is called long-term liability. Sometimes, let's take one more example. If we are paying our long-term, you can say loans every year as well. Let's say I have a car, and just to give you the idea, I have a car, I have to pay $200 every month to the bank. So it means the car, I have to pay this thing for 5 years. So it means for 4 years, that $200 is actually, I have to pay every month. So it means in 1 year, I have to pay almost $2,400. And for the rest of the money, I have to pay in 4 years. So it means that $2,400 will be, because that I have to pay, even it's a part of my vehicle finance, but I have to pay this $2,400 this year. So this $2,400 will be part of my current liabilities and rest of the money will be part of my vehicle finance. Just to give you the idea, I buy a car for, let's say, 6,000. And out of the 6,000, I have to pay, let me make it 5,000 so it will be easier. So if I have to pay $5,000, I bought a car for $5,000. I have to pay 1,000 this year and 4,000 in the next 4 years. So it means I'll be paying this money this year and 4,000 in the upcoming years, like not this year, after this year, I have to pay 4,000 more. So it means this 1,000 will be called current portion of long-term debt. So you can type it in small. Long-term liability is also called long-term debt. So long-term debt, 1,000. Vehicle finance is 5,000. You'll be paying 4,000 starting next year, but this year you'll be paying $1,000. So this $1,000 will be part of your current portion of LTD. And because you have to pay it within 24 months, sorry, within 12 months, that's why that will be part of your current liabilities. So that's how you can even, it's not only for the vehicle finance, you can think the same way for your mortgage loan, for your machinery finance, for your business loan. So whatever the part that you need to pay for your long-term loans within this year, you can put that amount in your current portion of long-term debt and put it in your current liability. So that will give you the real picture of the business, how much cash you need to be in the, you can say in the safe, you can say safe zone. So next thing, so once you have the liabilities, the last thing you have is the equity. So equity is, you can say equity is the owner's capital or partner's share in the business, or if it's like LLC, then the shareholders equity. So equity is something that is the investment of the people in the business. So let's see if the owner's equity is, let me type it. was, I just type the definition. It's the investment of the owners in business. So let's think of it. If I invest $100 in the business and my loan from different places, or if I have to, so if I have a, let's forget about everything. If I have the equity of $100, so it means either I have some asset of $100, let's say maybe I have bought a car for this amount, or maybe I have something in my bank or in my hand. So it means for this business, I have to have $100. So this $100 should match this side. So always remember that the formula for this balance sheet is always assets equal to liabilities plus equity. So always whenever you find the number here, this number, and this number always be equal. So whatever the total of your, let me highlight it so you remember it. So you can see whatever the asset side is, if you make a total of all the numbers, and if you make the total of your all the liabilities and the equity, those two numbers will always be equal. Just remember this part. So if you remember this part, if I have $100 in hand and my equity is $100, it means it's a match. I take a loan. Let's say I go and let's say I take a small loan, let's say mortgage loan, or let's say if I take a mortgage loan, let's take example here. So I take the mortgage loan of 1,000. So it means now I have 1,100 on my right side, but here I have only $100. Why? Because when I took this loan for the mortgage, it means I bought a property. So I have to put the value in this place as well. So now this number becomes 1,100. This number becomes 1,100. If I sell something, let's say if I have the inventory, I sell my inventory of $200. So now you see, if I sell it, my this side becomes 1,300. And if you see here, this is 1,100. It means either I receive, because I have sell my inventory here. So it means my inventory is gone. So once the inventory is gone, I just put it as inventory addition. So if I buy some inventory, so if I buy this inventory, so there may be two scenarios. Either I pay by cash or I take a loan. Like I say that I'll pay you in 15 days or 30 days. So you can see here, my inventory is increased. So my left side has increased to 1,300, but this side is 1,100. So either if I paid in cash, then my $200 will be gone from this side. But let's say if I don't have $200, so I have to take a loan or I have to pay on credit. So what will happen? Let's say if I buy the inventory for $200, so my amount in this side will be increased by $200. So you can see it's a double entry system. Whatever you do on the one side, it impact to the other side. Sometimes, let's say if I buy inventory of $100 more, so this 200 become 300. But this time I pay by cash. So what will happen? My cash will become 0. So either my impact will happen on the same side or on the same side or on the opposite side. Maybe after a few days, I feel that I want to increase the size of my business. I invest my equity from $100 to, let's say, 1,000. So when I increase the equity from 100 to 1,000, it means there's an increase of 900 in my business. So here you can see the business size is 1,000, 2,000, 200. And here my business size is 1,300. So it means there is a gap. So what is the gap? 1,000, 2,000, 200, and this is 1,300. So you can see the gap is 2,200 minus 1,300. So 900 is the gap. So I can simply type 900 because where this money will be going, it will be going to my cash in hand account or bank. So 900 will be here. So now this side will match is exactly the same on the right side. So that's how the balance sheet will work. So let me take you to the next step. So what we have learned in this balance sheet, that whenever you are doing a transaction, it has an impact on the other side or on the same side. depends on the type of transaction. Let's take the example of one more. Let's do some more learning here. So this is the balance sheet. Let's discuss about some journal entries. So whenever you're working the journal entries in the real life, almost 80% of the entries are involving your assets or liabilities. So most of the time when you're doing the entries, you are playing with any of these two items. So instead of learning all of it, I just show you how to work with these two items. So you will be covered with most of the transaction that you do on day-to-day basis. So let's learn this part. If you are doing the transaction or journal entries, so the item that you'll be working with will be either the assets, like in most of the time, or the liabilities. If you can do these type of transaction, automatically you will learn how to work with the rest of the transactions based on the theme you learn from here. So what we have learned that the entries, 80% of the transactions involve these two type of entries, assets or liabilities. And the next part is whenever you are doing the journal entries, you only have two options. Either you'll be doing the debit or credit. So it means all of your journal entries are either the debit or credit. So you don't have any third option. You only have these two options, either debit or credit. And you have the two type of entries that is actually, you have two type of transactions, which are mostly covering your 80% or more of your transaction types. So those are asset and liabilities. So in order to learn all the journal entries, I just make one shortcut just to give you the idea. So the shortcut is just remember the word aid. So what does this word aid says? Aid says if asset increase, it's debit. So you can see here with the A, when this asset so this aid word is actually helping us in running all the four type of transactions. So so what are the scenarios? Either your assets will be increasing or decreasing. Your liabilities will be increasing or decreasing. So there are only four scenarios you have. And just because if you know the first way, like asset increase, it's debit, you can learn all the four type of entries. So if asset is increasing, it's debit. So what would happen if the asset is decreasing? So you can see you only have two options. If increasing is debit, then decreasing is credit. As simple as that. And then you see asset is on the left side, liability is on the opposite side. So it means whatever the function you are doing here will be opposite for the liability. So if the liability is increasing, you can see here when the asset increases, it's debit. So opposite of asset is the liability. One is you own, the other one is you owe. So it means they are both opposite. So if asset increases, it's debit. When the liability increases, it's credit, because it's opposite to the first one. And the fourth option is where if you know that the liability is increasing, it's a credit. Then it means if the liability decreases, it's debit. So if you know the first, if you just remember this word aid, you can derive 80% of the transaction out of the for the journal entries. Let's do two transactions for the one is for the buying and one is for the selling. So let's say you are buying in this place and you will be selling in this transaction. So let's do a transaction of buying a calculator. So if you are buying a calculator, what is the impact? So calculator is an asset, right? So your inventory will increase. So when you buy a calculator, your inventory increase. So let's come here. So when your inventory is increased, it means your asset is increased. When the asset is increasing, it's a debit. So calculator when you buy, let me put the headings here. Items, debit. Right. So let's say you are buying calculator. So buy, I can type it directly, calculator. So I was buying the calculator. So calculator is an asset. So when the asset is increasing, asset is a part, calculator is an inventory, and inventory is part of my asset. So it means when I buy a calculator, I have one more. Previously, I don't have any calculator, but right now I have one calculator. So it means my calculator is increased. So when the calculator is increased, it means asset increase. So it means it's a debit entry. So let's say the price of the calculator is $100. So I type here $100. And then because now there are two scenarios. Either you pay by your accounts payable, or you sell it or buy it. Okay, we buy it. So it means when we buy it, so it means either we buy by using our cash, or we use the accounts payable. So let's say we buy it by the accounts payable. So it means accounts payable. We did not pay it on the right away. We paid like after with the promise that I'll pay you after 15 days. So accounts payable will be generated, and accounts payable means our liability increases because right now I don't have anything to pay. But when I say that I'll pay you $100 afterwards, so it means my liabilities increases by $100. So whenever your liability is increasing, it's a credit. So you'll be marking here as $100 as credit. After 10 days, when you receive money or when you have money, you went to the same manufacturer or someone, and you say, okay, I have money, I'm giving you money back. So what you will do, you will be, again, the similar transaction. You will be saying that against that $100, I am paying you $100. So it means that for against accounts payable, which was in your books, so it means your liability will be decreasing because now you have to pay $100 and you are paying that $100. So what will happen? When the liability is decreasing, it's a debit. So you just need to create one entry. We'll say, okay, accounts payable. So you can see when the liability is decreasing, it's a debit. So you have to put $100 in here. And then you are paying cash. So when you pay cash, what would be the impact of it? Your cash will be reduced. So when your cash is reducing, it means your asset is reducing. When your asset is reducing or decreasing, it's a credit. So you will put this cash as paid. So now what will happen? This accounts payable that was at one time credit, and this accounts payable that was at one time debit cancels each other. So that's why these are called reversal entry or canceling entries. So once they cancel each other, what is the net impact? So what is the net impact? You have the calculator, $100. The cash is gone by $100. Why? Because these two entries cancels out each other, and you are left with only this entry. Calculator is like you receive the calculator and you give the cash away. So this is the one transaction when you are buying the calculator. Exactly the same way if you are selling the calculator. Right? So let me type here items. Debit, credit. So here comes the first thing. If you go to the market and selling your calculator, so it means calculator was your inventory. When you sell the calculator, it means your inventory is reduced. Previously, you have $300 worth of calculator. Now you have only $200 worth of calculator. So it means you sold a calculator which reduces your inventory by $100. So let me type here as calculator. So once you type calculator, it means this calculator has reduced the price. Now, how much the price is reduced? Let's say by $100. So your calculator value is reduced by how much? $100. So it means asset value is reduced by $100. So when it's reducing, it's a credit. So you can type here credit. So once you have sold it against account receivable, let's say the person who bought it, he said that he will pay you in 10 days, 15 days, 30 days. So you said, okay, so now this is a time that you cannot just keep the things like this. When the calculator is gone, your inventory has reduced. You need to put this money in some place. So you will say account receivable, and let's see what the account receivable is. So we can see account receivable is an asset. And what's happening? Previously, there was no account receivable, but now there's an account receivable. So it means my asset is increasing. So when the asset is increasing, it's a debit. So it means I have $100 as debit amount. After 10 days or 15 days, the person comes in and then he say, okay, take your money back and so that we can finish the transaction. So there's a time that when the person comes in and he give you your account, like the money, so it means your account receivable will be decreasing. So it means again, when the account receivable is decreasing, it means asset is decreasing, which is a credit. So you can type here, sorry. Account receivable is a credit transaction. And what you got, because he paid you, so let me put it in the next line. Oh, let's put it here. And you got your money back. So cash, you got it. So cash is your asset. So once the asset is increasing, it's a debit. So you got your $100 here. What is the impact? This account receivable and this account receivable, you can see one time it's debit and one time it's credit. So it means they both nullify each other. They both are canceling. So when they are canceling each other, so once they cancel each other, what is the net impact? You sold the calculator for $100, you got the cash $100. So you can say cash debit, which is $100, and calculator credit, which is for $100. So now you can see your balance sheet will show that net impact as cash has increased and calculator's value is decreased. Here, your calculator will be increased, like inventory is increased, but your cash is decreased. So you can see here, if someone has bought it right away, like if someone has given the money right away, then the impact would be this. But because we have done account receivable, account payable transaction, that's why this entry is created and then reversed when we are like reversing the entry. So that's how the transaction works. So now let's apply this knowledge, what we have learned now, onto our QuickBooks. So on the transaction we have is on page number 164. And we are doing a transaction for journal entries. So you can go to the, like if you want to do the journal entries in QuickBooks, you have to go to the company and then like make journal entries, this button, click it. Click OK, system will automatically give the numbers. So the first transaction we are doing here is as of 3rd of January 2023. So this date is correct. Click tab. Entries automatically come here. So here we are doing the first transaction. So we are actually selling our services to a customer. And our services which we are selling to the customer is, you can say, is our services, which is corporate event. So we talk to one of our customers and we agreed that we will be providing them with the corporate services. And for that, they will be giving us $20,000. So now let's learn about it. So when we are giving our services and getting money, we are not getting money, but we will be getting money after a few days. So it means our account receivable will be increased. So let's go up and then see what the account receivable is. You can see our account receivable is our asset. And when the asset is increasing, it's a debit. So let's do here. So we are doing here as account receivable. I think this account is not yet created. Let me create. Okay. So I just created the account receivable entry because this was not previously created. We are doing it for the first time. So I created the account receivable entry exactly the same way we did it in the our chart of account. I created one account as the account receivable. So now I'm doing it. So the first thing is I can just come here and I can type account receivable. It will come up. And as I just show you that account receivable is our asset. And when the asset is increasing, it's debit. Let's go to our QuickBooks. So we'll be putting the money in the debit side, right? And then click tab. In the memo, we can type from where we got this money, total earned from R. Wilson. And here we can type the name of the customer like R. Wilson, R. Wilson, or Wilson Rosa. Wilson Rosa. Click tab. This customer is not part of our customer list, so we are just quick adding this customer. Quick add, and it's a customer because they are buying from us. So click it, click OK. And now this money is gone. Sorry, this money will be received after some time. So by that time, what we have sold to this customer, so that will be corporate event. Selected corporate events, exactly the same way. And again, you can see you have sold something, the opposite of debit is credit. So system has not even asked you where to put it because there's only two options. You have already selected that asset is actually increasing, so it's a debit side. System has automatically taken the second item, which is our sales, into the debits, into the credit side. And then we can just update the same information, total earned from R. Wilson Rosa, and the entry is done. Simply save and close. So now the transaction is done. We are good with it. After 30 days or 40 days, whenever, as per the agreed terms, customer comes back to us and then he says that they have deposited money in our account, or maybe they give us a check or something. Now this is the time that we have to pass the reversal entry. So how can we do that? Again, we can go to the company, go to the general entries here. You know that it's automatically creating the number 2 account, like transaction number 2. And then we have to do the same thing. The transaction, the money we are getting is on 02/03/23. And then we are receiving money. So it means the money is going to our checking account. So what will happen? When we receive the money will be going to our checking account or cash at bank. So when it's going to our bank account, it's an asset. And when the asset is increasing, it's a debit. So let's come here and we type here our checking account, Metropolis checking, and how much money we are getting, 20,000. So we have to put here 20,000. Memo, deposit by R. Wilson, tab, Wilson Rosa. You can just simply start typing and we'll get the name. And then you can come here. So previously you have account receivable. The customer has already paid you. So now there is the 20,000 account receivable that you have is now become 0. Why? Because the customer already paid you. So when the account receivable gone reduced, it means our asset is reduced. When the asset is decreased, it's a credit. So just simply come here and you can see this has automatically taken the amount into the credit part. And this was account receivable. So I can just type here account receivable. Here we can type received from R. Wilson. and then type here Rosa, and it will be Wilson Rosa. So we have done 2 transactions. Simply say save and close. Yeah, of course, we are doing the transaction like 30 days in future because we are doing all the transaction in 2023. Say yes, and all done. So that's how you can do the transactions or general entries in the QuickBook. So yeah, any question?
No, I followed you.
Okay. So let me come to your screen and then